Welcome to the Cliffwater Direct Lending Index quarterly webinar for 4Q24. My name is Fran Byers. I'm the head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater and the creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor founded in 2004, and we are active across the alternatives investment spectrum. Steve's going to kick things off with a recap of direct lending return performance in the fourth quarter, and I will follow with a recap on recent trends within the direct lending market for the first quarter of the year and discuss how managers and investors are reacting to the recent market volatility. And with that, Steve, please start us off.
Thanks, Fran. So just to review our suite of index products, this is a list. Our flagship index, the Cliffwater Direct Lending Index, or CDLI, started in Q4 2004. So as of today, it has over a 20-year history. It's the primary index we use for direct lending, private debt research. We also have a senior index, just focused on senior-only debt. We have a venture index, again, just focused on venture-backed middle market loans. A perpetual index, non-traded perpetual index. These are BDCs. This is quite honestly a very rapidly growing segment of the BDC market, basically from zero 3 or 4 years ago to over 100 billion today. So we have an index on just the performance of non-traded perpetuals. And then for most of our indexes, they're gross of fee, unlevered. We introduced earlier last year a unlevered net of fee index, a levered net of fee index, and then we introduced last quarter a upper middle market and a lower middle market index. And so we'll continue to expand on our list of indices, but I'm going to talk really about our flagship CDLI index in this presentation. Next page. So 2024 was a relatively quiet year for private debt, really the second year of really progress, which was mostly capturing interest income with low losses. If you look at calendar 22, let's just go to the numbers. In the first column, 11.32% total return. That's unlevered gross of fee. Most of that, if not all of it, coming from interest income of 11.91%. Realized losses for the year of 69 basis points. Most importantly, that's below the long-term average of 1.01%. And basically, that's been the record over the last few years post-COVID, low credit losses, low realized losses. And both for 24 and the prior year, really captured through the first over the last 5 years, performance has exceeded the from inception period. If you look at CDLI return from inception, 9.55%, basically recent years have been above that, primarily because of high reference rates and low realized losses. At the bottom of the slide, basically show the quarterly returns. Very good pattern of returns stream, basically quarter by quarter between 2 and 4%. Only a few periods during COVID and during the Great Financial Crisis to be witnessed negative returns for the asset class. Next page. Thank you. Basically, long term, this is an asset class that is reflected by yield and credit losses. And if you look at the bars, that's 4-quarter trailing income return, and that's the positive. The negative would be realized losses in the red line. And if you notice that the gap or difference between the two has always been positive or has always been significant, except for the financial crisis, where losses grew to almost 10%. They were still exceeded by interest income. So, the gap, the difference in return was mid to low single digit. But basically, the investment thesis behind private debt and direct lending is represented by our index is that you can capture over time a significant premium in return through yield, offset by a small amount of credit losses. Next page. This is a chart I produce once a year, and it basically shows calendar year returns across credit asset classes and also standard public credit asset classes. So in the first column, I showed the Cliffwater Direct Lending Index year by year, then followed by two columns showing public credit asset classes represented by the Bloomberg High Yield Bond Index and the Morningstar LSTA Leveraged Loan Index, and then followed by a couple standard fixed income indices, the Aggregate Bond Index and 1 to 3 month Treasury bills. I like this display. It highlights in blue what the best performing asset class was. And as we've been saying, private direct loans represented by index basically went out, I think 13 of these 20 quarters. And you can see that the second in second place, it's a distant second place, is the Bloomberg High Yield Bond Index. Interesting, the Leveraged Loan Index never wins. Okay, and there have been a couple of years where the Bloomberg Aggregate Bond Index have produced the highest return because of dropping interest rates. One final point. Let's look at the bottom of the page. Basically, private credit has been producing 9 to 9.5% compound annual return. Okay, that's been about 5% better than high yield bonds represented by the Bloomberg High Yield Bond Index, and about 4% per year better than the Morningstar Leveraged Loan Index. And of course, credit generally, whether private or public, has outperformed the investment grade aggregate bond index and treasury bills by a very significant amount. Next slide. Just want to make a couple comments on the state of the market, then turn it over to Fran. Kind of one thing we've been keeping our eye on has been the liquidity in the private debt market. Liquidity for us is measured by effective life. Over a long period of time, the effective life is about 3 years, or the effective maturity, could call it, for direct lending, about 3 years. And that we noticed starting in 22, when interest rates started to go on the rise, that liquidity started to dry up for private debt, and the effective life reached almost 6 years. That has started to repair itself, and effective life has now come down largely because of refinancings below 4 to 3.78 years. So the good news is more liquidity is coming into the market through refinancings. Next page. And then kind of the first order measure of risk is non-accruals. Okay, and we've put together a graph here which shows non-accruals over time. The most important measure here is this dark solid presentation, basically shows non-accruals as a percent of cost value or as of par value. And it generally stays at about 1.5% to 2% over time. I think the long-term historical average is 2.2%, but it's basically stays low, sub 2%, but for spikes. Those spikes are generally correlated with inflation. But right now we're looking at a non-accrual rate that's, pretty close to the long-term, to the low long-term average at 1.3%. It's kind of sat there for the last couple quarters, and which basically reflects the fact that these portfolios, at least as of 12/31, were in pretty good order in terms of quality. And then finally, PIK went through the first quarter as a big topic. We talked extensively to our investors and others about PIK. We talked about two types of PIK. PIK that is basically negotiated when the loan is originated as an option to give borrowers some flexibility. That's not bad PIK. It's call it good PIK or neutral PIK. Bad PIK is when there's a restructuring and the part of the negotiation is a transfer from cash payments to increases in principal. So that's what we might call bad PIK. Together, though, we've been measuring both sources, and together they've been over the last few years averaging about 7 to 8% of total interest. So if the headline coupon is 10%, if it's 8% PIK, it basically means 80 basis points of the 10% is PIK income. So on average, it's been a small amount, continues to be a small amount. I think it's something worth looking at as a measure of stress in the market. Most recently, during COVID, we saw significant spikes as some borrowers were able to negotiate temporary adjustments of their interest obligations from cash to PIK. With that, let me, next page, turn it over to Fran.
Thank you so much, Steve. So on our last CDLI webinar, we were very bullish on deal flow heading into 2025, as the fourth quarter of 2024 produced the second highest quarter on record for M&A volume within direct lending. There was lots of positive momentum heading into the new year once we had more certainty surrounding the economy and the new administration. But obviously, what started as euphoria in the markets in early January with the hope of strong economic growth was quickly rattled in February and March by uncertainty. And now in April, the markets are becoming very volatile, both related to how tariffs and cuts in government spending and policies would impact borrowers and how it would impact the overall health of the economy. And so I want to spend a little bit of time just talking about what we're seeing as the first quarter concludes, both in the leveraged lending market and how direct lenders are navigating these new challenges. So we'll start by just looking at recent news headlines on tariffs, changes to government spendings and policies, and how it's impacting the more visible parts of the loan market, which would be the broadly syndicated loan market. While we have seen wild swings in equity markets as of late, I would argue that to date, the impact to the loan market has been a bit more muted than we would have expected. Although following Trump's announcement just this week, we are starting to see more signs of investors retrenching. But starting with the chart here on the left in the light blue line, we can see the share of loans in the institutional loan market and what percent is trading at par plus. So we've seen a very steep decline in March. The strength of investor sentiment early in the year, coupled with strong inflows and technicals, had driven nearly 50 to 60% of the secondary market to par or greater. And then we can see that in the middle to the end of February and into March, we had a heavy collapse where now only around 10% of the institutional loan market is trading at par plus. While that may seem like a sharp decline, the dark blue line, which shows the average bid in the institutional loan market, so far has only fallen about 1 to 1.5 points in the past month, which is not very material at all, considering the big changes that are being contemplated by our government. Certain sectors have been harder hit than others, clearly. We lay those out for you in the right-hand side chart. So announcements on tariffs related to steel or copper hit sectors like construction, aerospace and defense, utilities, and industrial companies. Tariffs on autos came later, and you can see that impact in the red line in the past week showed a very sharp decline. And then those consumer-heavy sectors like retail, restaurants are also reacting due to recession fears or a slowdown in consumer spending. Unlike the second half of 2024, which was characterized by strength and stability of sentiment, it feels like the markets will remain more volatile, particularly as the technicals in the syndicated loan market have weakened in recent weeks. After many weeks of positive billion-dollar plus inflows into loan mutual funds and ETFs in the first 2 months of 2025, outflows from retail investors began to materialize in the past 3 weeks. And so time will tell if this begins to stabilize or if it will continue over the next couple of weeks. Turning to the next slide, we can begin to discuss what the biggest impacts have been to the direct lending market. So direct lending tends to react with a 1 to 2 quarter lag and also tends to be far less volatile as investors are making medium to longer term allocations to the asset class. And most vehicles within direct lending are not designed for hot money investors, and they tend to be more stable. And so to analyze any volatility hitting the direct lending market, looking at public BDC share prices is a good place to start, as they tend to be the most volatile of all the vehicles, given that they offer daily liquidity. So for those of you that are looking to track this, Cliffwater does host a website called bdcs.com, and you can go there and pull up the Cliffwater BDC Index, which we have listed here in the chart on the left. We charted here for you whether BDC share prices are trading at a premium or a discount relative to their book value. Typically during periods of market dislocation, you tend to see public BDCs trade below book value. During periods of relative strength, they trade above. Of course, it's important to note that performance does vary based on manager quality. But so far in 2025, public BDC investors appear to be staying the course. The index is trading at or around book value, which is a positive. This means investors are not too worried about portfolio health or the return profile of their direct lending investments, and they're staying the course within their fixed income allocations. And in the chart on the right, we do continue to see strong inflows into evergreen vehicles such as interval funds and BDCs, which are raising money from the wealth channel up until February of 2025. And so we actually continue to see a very strong technical backdrop within the direct lending market. Turning to the next slide, we can discuss then where direct lenders are feeling the biggest impact, and that is surrounding deal flow. Heading into January, there was a lot of momentum for M&A to come together. Now, while first quarters tend to be the most seasonally slow of all the quarters, things were actually looking really promising in January. However, once the tariff news and the massive government policy changes started to surface, there was a very visible slowdown in deal making as PE sponsors began to move to the sidelines. It's really hard for a PE shop to think about writing a massive check and pay a hefty valuation multiple with so much uncertainty. On top of that, many sponsors are now switching their focus to portfolio optimization on their existing book because they have to try and figure out what strategy changes need to happen to keep margins sustainable or how to continue to grow their book in light of massive tariff risk, which is changing daily. And so slowing pipelines has been the biggest concern for lenders so far this year. And you can see that slowdown in the chart on the left through the February figures. We do think the tariff news does push the hope for M&A more into the back half of the year now versus we were more optimistic we were going to see nicer M&A volumes in the first half. In looking to the chart on the right, we can drill into which sectors within the CDLI are most exposed to these headline changes. The good news is for direct lenders is they tend to have the highest share of their portfolios in more recession resilient, defensive, and asset light businesses. So technology, business services, financial services are somewhat insulated and less susceptible to a lot of the headline noise. However, there is a decent chunk of the market exposed to consumer, industrials, materials, and even services and healthcare companies cannot remain completely untouched from big changes in tariffs or changes to things like Medicare, Medicaid reimbursement. And so until there's more clarity and stability and some more time goes by, we do need borrowers to have that time and more confidence in how to react to these massive changes. So we do believe supply will be impacted in the first half of the year, although the desire and need to transact is still very much there from both lenders and sponsors. Flipping to the next slide, we can analyze how spreads and pricing is reacting and changing across the landscape. So in the chart on the left, we compare BB rated and single B rated loans in the public broadly syndicated loan market in dark blue and light gray, and how that is changing relative to the direct lending market in the turquoise line. As we all know, direct lending tends to have 150 to 200 basis point liquidity premium relative to a single B rated syndicated loan, and that still holds true today. However, you can see in the dark blue and light gray lines that the syndicated market is starting to show upward spread price reactions to the recent news in the month of March, while direct lending has remained insulated and muted and is still near all-time tights. Investment banks are somewhat less confident today in their ability to take on underwriting risk relative to 2 months ago, given they're seeing large outflows in the public markets, and even CLO managers and investors have shown more caution in recent weeks. Investment banks are now even adding more price flex, wiggle room to their underwrites to prevent them from being hung with deals, given that the risk of further volatility and investor retrenchment is still there. We actually view this as a positive. This upward movement in price and flex in the BSL market is a positive for the direct lending market, because any volatility in the syndicated market can spook private equity shops and incentivize them to just go back to private markets, which can help drive more supply. So we're hopeful that this helps push pricing up in our market and brings more M&A to our market on high quality deals. But again, there is always that lag in pricing. And looking in the chart on the right, we do break out for you spreads across the lower, the middle, and the upper parts of the direct lending market from an EBITDA standpoint. Wherever you're in the middle market, whether it's upper, lower, middle, all three segments are showing first lien spreads in that 475 to 525 area, and everyone has seen tightening. In fact, the middle part of the market, the $40 to $100 million EBITDA segment, has actually shown the greatest spread contraction quarter over quarter through 1Q 2025. The one thing that the chart doesn't really show well here on the right is that the market is becoming more barbelled or bifurcated based on credit risk, given the backdrop. So what's happening is very high quality and defensive credits are garnering super tight spreads in the 450 to 475 basis point area, in addition to more borrower-friendly terms, while tougher credits that have numerous credit risks that could have more binary outcomes based on Trump's policies, they're seeing much wider spreads on their deals. And some of those deals are either falling away altogether or they're getting shelved until more certainty and clarity surfaces. So moving to the next slide, we can pivot away from the new issue market and talk a little bit more about credit health, because it's been a big question that investors are coming back to over and over in the last couple of months. Steve showed non-accruals earlier. We also chart for you on the left defaults and the PIK rate we're going to get into as well. But overall, the default rate is still remaining pretty benign. We're at the 2% level, which is well below historical levels. We tried to break this default rate out for you by sector, so you could see if there was stress brewing in different parts of the direct lending market. Most notable was the pickup in the default rate within the consumer retail discretionary sector. The default rate jumped from 2% last quarter to over 3% in 4Q. We are actually seeing an improvement in healthcare. That was a sector that really struggled coming out of COVID, but we've actually seen the default rate in the past few quarters fall within the healthcare segment, which is good because it is a 15 to 20% market share within the CDLI. Industrials is notable. This is a space that did really well coming out of COVID and had a very low default rate all the way through 2023. Industrial companies tend to be lower levered, and so the rise in base rates, it didn't result in a wave of defaults in the space like people would have maybe expected. And it showed a default rate far below the average for some time. However, we are seeing a very modest rise in the industrial sector in the default rate in the past 3 quarters. It's moved from, even though it's 1.5%, it's still benign. Tariff risk is present in that sector, so it is one to watch. And then moving to the last slide, obviously non-accruals are low, defaults are not spiking. So the next natural questions we often get from investors is, well, is a lot of stuff moving to PIK, right? Is borrowers just going on PIK to avoid a default? And so we tried our best to dig into this theme for the market. We dug deep, looking at all the loans within the CDLI that had a PIK component turned on and tied to the interest rate of their loans. And we looked at just loans where the PIK rate was greater than 200 basis points to see if we could find stress in the market. And we broke this down for you by sector. Now, the challenge many investors face is how do you decipher between restructured PIK and PIK that was placed on the borrower at origination? And so sometimes the best way to analyze that is to look at the mark on the PIK loan. If the loan is beginning to get marked down and marked below 90% of par, you're getting much closer to figuring out that the PIK loan is probably there because the borrower is facing material liquidity pressures. And so we charted both of these analyses for you here. The big takeaway we are seeing is there is an increase in PIK happening in a few sectors. Consumer retail and media are two that, if you look in the chart on the left, is prominently showing a pickup in PIK. This makes sense because they're both more discretionary spending type industries. Media advertising can be sometimes the first thing that gets cut by businesses when cash flows are getting tight. And of course, the consumer tightens the purse strings when sentiment is down. And so those two sectors have shown a material rise, and we're watching those. And then on the slide, we also saw earlier, non-accruals are also showing a pickup in consumer as well. So that is all kind of tying together. Industrials is also another sector where you don't often see a lot of PIK in the industrial sector. So if you tend to see PIK in that sector, it is probably because the PIK rate is growing within that market. Business services, financial services have actually been showing a decline in PIK because there hasn't been much stress in those sectors. And with spreads and base rates falling over the past 12 months, those sectors have actually been being alleviated from cash flow pressures. Technology is the sector that typically utilizes PIK the most during origination. This is particularly true in ARR lending. So we can see in the chart on the left here that tech is a little bit elevated in most quarters in that 10 to 15% area in terms of having PIK in the interest rate. However, the chart on the right shows you that the share of term loans with PIK marked below 90 in the tech space is pretty limited. So it proves the point that direct lenders are using PIK to win deals as an origination tool. It's not necessarily when you see PIK that there's liquidity pressures in that sector. At the end of the day, Steve highlighted earlier that losses are what matters most to investors, and that's what impacts your returns. And to date, the CDLI has been showing very muted losses, which implies that the direct lenders are continuing to navigate this market well, and a lot of the uncertainty that's been being thrown at it. That concludes our prepared remarks. I'm going to turn the presentation back to Steve to sign off.
Thanks, Fran. And thanks everybody for joining us today. The outlook, well, looking in the rearview mirror, things look pretty good going through 2024. 2025 has gotten off to a interesting start with tariffs and a lot of price volatility. We'll keep you posted quarter by quarter on what develops. But we feel confident that private debt, particularly senior secured direct lending, will perform well in this turbulent market. And we expect to demonstrate that over the coming quarters. Thanks again for attending.